Welcome back to the second episode of Tune to Finance, and we're talking about short selling here. So my expectations would be the prices to go down, and another name for that will be the bearish market. So whenever I say that we are bearish on certain stock, it means that we expect the price of the stock to go down. And short selling would be borrowing shares today, selling them immediately to receive cash, and at maturity you return the shares to the broker plus dividends, and hopefully if prices actually go down you will have a return. Now in this section I'm going to explain what's going to happen at maturity. So we are back to the same example. I had to sell short 1000 shares at price of 100 at time zero. I should pay $1 per share at maturity. The percentage margin, which is in the form of securities, would be 50%, and that was calculated to be $50,000. My cash amount was $100,000, and this is the amount I have received once I have sold the 1000 shares. Now let's say that after 1 year, which is at maturity, the price is $80. So what happened is that the price went down by $20. So what's going to happen here hopefully would be a positive return. So I'm going to calculate the return after 1 year, and before doing so I need to calculate the total dividends that I have to pay, and this would be the dividend per share times the number of shares. So this would be total of 1 times 1,000. $1,000 will be my total dividends paid, and the interest that I receive on my dollar margin requirement is the interest rate times the dollar margin times n over 12, and because I have 1 year investment, n over 12 will be 12 over 12. So 50,000 times 0.1 times 12 over 12 will give me $5,000 as interest received. And the return would be this formula of number of shares into P0 minus P1 plus interest received less dividends paid divided by the dollar margin requirement. And another name for the dollar margin requirement would be the initial margin, or simply the initial investment. So using this formula, the number of shares is 1000, P0 minus P1, 100 minus 80, the interest received is 5000, and the dividends paid would be 1000 divided by $50,000 margin requirement will give me a high return of 48%. Now the reason was simply because the prices went down as much as I expected, and because I have received interest on my margin account, and that was much higher than the dividends that I had to pay. Now luckily I made a good profit, which is 48%, and next would be calculating my remaining margin, which is at time 1 or at maturity, and the remaining margin is the margin at time 1, which is asset time 1 less liabilities time 1 over the value of stock time 1. Now the assets at time 1 will not be only cash and dollar margin requirement. One more item will be added to my assets at time 1, which is simply the interest received on the dollar margin requirement. So my assets time 1 would be cash plus dollar margin requirement plus interest received on dollar margin requirement. And my liabilities at time 1 will also change to add the dividends paid. So liabilities at time 1 will be the value of stock at time 1 plus the dividends paid at time 1. And of course the remaining margin should be divided by the value of stock at time 1, which is simply the number of shares times P1. Using this formula, I will simply add my cash, dollar margin requirement, and the interest received. This will be my assets time 1 less my liabilities time 1, which is value of stock, $80, P1 times the number of shares, plus the dividends paid divided by the value of stock, again P1 times the number of shares. And my remaining margin at time 1 is 148%. So I have a big increase in my margin simply because the prices went the way I expected and I had a huge return on this investment. Now the percentage margin or the initial margin was 50% at time 0, and at maturity it went up to 148%. So luckily the expectations were right here and I had a positive return. Now if the prices went up, then my return will definitely be negative because my expectations were wrong, and of course my return will be negative and the remaining margin will also fall. Now we don't know how much will it fall. It all depends on how the prices went down. So that was the concept of short selling. It's very simple. What happened here is that I expected prices to fall and I borrowed shares today, I sold them immediately, I received cash, and at maturity, what happened would be expecting prices to fall so that I can buy them back and give them to my broker. Luckily, I had a good return of 48% and increase in my remaining margin. So everybody, this is the end of our session, and I hope you really enjoyed this episode of Tune to Finance. Don't forget to follow me on Twitter, it's Izzy1071. My YouTube channel is Azzat Ramadan, and my Facebook page would be Tune to Finance. So make sure you press the like button when you log on to my Facebook page, subscribe to my YouTube, which is Azzat Ramadan, and of course follow me on Twitter, Izzy1071. So everyone, I hope you tune to finance.